This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Darius's picture saying, looking for the downloads. Eric, let's cover crude oil, starting with those EIA inventory numbers.
EIA posted a crude oil build of 5.9 million barrels, which was really only 5.5 million barrels after another 0.4 million barrels were pilfered out of the Strategic Petroleum Reserve. I've lost count whether that's the 14th or 15th consecutive week in a row that they have continued to draw down the SPR during the period that they promised us they would be refilling it. Cushing, Oklahoma, drawing down a very, very large 1.6 million barrel drawdown. Gasoline drawing down a de minimis 3,000 barrels. Distillates building 4.8 million barrels. U.S. production ticking back down 100,000 barrels to 12.3 million barrels. Tape action, well, there was already a rally in progress before the data came out, and despite what normally would have been bearish data, that didn't slow the market down. EIA issuing an upward revision to its demand outlook was the principal factor behind this week's crude oil rally. We've reached a level now where, on a technical basis, it's starting to look like this could really have some promise. So, Patrick, I want to ask you to weigh in on the technicals. I see lots of reasons to be long-term bullish crude, and Dr. Anas Al-Haji told us to expect the crude oil market to turn bullish in the second half. So maybe we're finally seeing the move that has promise. We'll have to get Anas back on for an update on the fundamentals, but meanwhile, Patrick, I'd love to know what technical signals you're watching to tell you that this isn't yet another bull trap, because we've had quite a few in the last year. And specifically, what signal will tell you when it's time to load the truck up on crude oil futures?
Yeah, Eric, it's been definitely a good 1-2 weeks on crude oil. It established a support line. It beat some key resistance levels around the very low 70s and is slowly re-entering the trade range from the first quarter of the year. What I think is interesting is to simply put on the 200-day and 50-day moving averages. And the reason I think this is interesting is simply because this one-year oil bear market that has seen oil half itself off the major highs, we have a scenario where it's spent a considerable amount of time below the 200-day moving average, really depicting that bear market decline. You can see that the 200-day moving average now lies just under $80 and just a stone throw away from where crude oil prices are. The way I look at this is that if crude oil can start working up and sustain price action in the $75 to $80 area, it will be doing some technical repair work and potentially building the foundation from which a more meaningful bull breakout can happen. I think that what happens up along this moving average, notice the last time in April when it tested the 200-day moving average, it was a very hard rejection. It'll be interesting to see whether this time around the bulls can actually hold the ground and maintain it even above that red moving average, which is the 50-day. There's a lot of repair work. It'll probably take the rest of July for this chart to keep constructively building. And then we're going to really find out whether or not something more bullish can happen on a sustained basis. Nonetheless, let's move on to equities. Eric, what are you thinking here?
The market's doing exactly what I predicted it would do. It's melting up for what, so far as I'm concerned, is no good reason. This close to previous all-time highs, if you're still a bear, you've got to at least be considering the possibility of a double top before the market reverses lower. None of it makes any fundamental sense to me, but the trend is strong and the trend is up.
Yeah, the trend is strong. I want to talk about that in a little more detail, but let's first get the levels here from Nick. Nick, what are you watching here on the S&P 500 based on the options market?
Spot price right now is 44.70. We have a call wall above at 4,500, which is just about 30 points out. We have a put wall far below at 4,200. The implied move for the July 21st OPEX, which is next Friday's OPEX, is plus minus 60 points. So the upper expected move is 45.30 and the lower expected move is 44.10, with key resistance right now at the call wall of 4,500. Key support below is at 4,400, 4,350, then 4,300. I'm thinking that we've gotten a bit too far too fast, and it's probable we see some stagnation perhaps in the S&P. We'll discuss how far it is away from the all-time highs in a few slides, but again, I'm thinking that we see some stagnation here, so perhaps a little bit of risk off going ahead a few weeks makes a bit of sense given that we have FOMC in 2.5 weeks roughly. What are your thoughts, Patrick?
Yeah, the S&P 500 remains in bull trend. And while certainly you can make the argument it is overbought, then based on all technical metrics, this is still a very distinct bull trend. Above all, its moving averages, above all trend lines, but sequentially making higher highs, higher lows, all dips get almost immediately bought. And while obviously I think there's a lot of things that can go wrong later this year, there is simply no technical evidence that this market has run out of momentum right now and as some major top is really that imminent. And while we could certainly reach a little bit of short-term overhead resistance here on this market, there is really nothing stopping the bulls beyond a bad earnings season from trying to at least attempt to test those major highs. We'll talk about it in a second, but let's move on and just put the levels on the Nasdaq on here. What are you watching on the Qs?
Now, the Qs right now, spot price is 373. The implied move for the July 21st OPEX next Friday, again, is plus minus 8 points. So the upper expected move is at 381 and the lower expected move is at 365. We're currently above the call wall right now, which is at 370. There's a put wall below at 360 as well. And we've broken above that key resistance level from the highs of March 2022 of 372. The next key area of resistance now is at 383. Key support resides at 350. Again, I'm thinking that maybe seeing the blow off top perhaps in the Nasdaq, but I am favoring the Russell over the Nasdaq right now in the short term, and I do think that a pullback is overdue. But again, shorting a very, very strong market doesn't make a lot of sense. So I'm neutral right now, perhaps, but I am looking for a short entry at some point.
All right. Well, you know what? On page 6, what I wanted to do is put up the weekly charts of the S&P 500, capturing the 2020 COVID crash and the subsequent rally that came afterwards. And so I have the S&P 500, Nasdaq, and the Russell charts up here. And what stands out to me, Nick, is that and the Nasdaq, which is in the middle, not only had arguably the most violent sell-off in 2022, but also reflexively the most violent rally. And what's interesting is that the Russell, which also had that very violent drop, hasn't even been able to beat some of the short-term highs that it's seen over the last year. And so it's truly been a laggard. Like you were observing, we're a stone throw away from all-time highs. And it really makes me ask the question, I mean, really, what does stop this market from not going for a retest up there? I know that we have very overbought conditions, but there's also no immediate catalyst for it to start selling. How do you size this up?
So my thinking is that looking at these three different indexes, we have the S&P, which is about 7% from all-time highs, the Nasdaq, which is about 8% from all-time highs, and then the Russell, which is about 21% from all-time highs. So my thinking is that I'm staying long small caps in the form of the Russell IWM, and this way, if I go short for Nasdaq or the S&P, for example, and we do run higher, I expect the Russell to outperform. So it's kind of like a pair trade in a way, somewhat. But my thinking is that right now, you can get about 5% risk-free on T-bills. So what would be the impetus for a portfolio manager, for example, to take the risk of further upside of about 7% on the S&P or 8% on the Nasdaq when you can achieve 5% or so risk-free on buying bonds?
Yeah, that is the big debate. But I think right now it's really the fear of missing out that is driving, and as well career risk that is driving that money flow to chase these markets. And, the interesting thing is that you mentioned that you're pair trading the small caps against the Nasdaq as a way of creating some sort of a hedge. But what's interesting, Nick, is that when you size up these option markets, we have these incredibly low periods of volatility, and it really allows one to construct a number of really interesting option strategies to actually have hedges that are relatively cheap to carry and still have the ability to kind of soften the blow if there was a left tail downside risk to the markets that emerges going into this third quarter of the year. I want to talk about that a little bit more in a moment, but I just wanted to touch on, Nick, though, on page 8, the 3-month SOFR futures, but going out to December 2023 on the contract. And what I find really interesting is that even back in the second quarter of the year, they were pricing in by the end of the year that Powell was already going to have started a rate cut cycle that would have gotten yields down to about 4%. And that was really at its height was obviously the first shock reactions to the regional bank crisis. But what we find ourselves is trading right back down to February, March lows on this, where essentially right now they're still betting that the Fed funds rate will be somewhere near 5.25 as we get to the end of the year, and that basically Powell will at some point keep interest rates here at these kind of levels all year long. It'll be really interesting to see whether or not we have some sort of event going into the fourth quarter that makes the market rethink this, right? Darius was talking about the recession risks that are coming into the fourth quarter, into the first quarter. You would think some of the leading indicators might start to flash red signals that may force these interest rate futures to start actually pricing those things in. Nonetheless, Nick, on page 9, we have the VIX, and here we are literally trading back down to 2019 levels, 13 handle on the VIX. It just seems such a calm and complacent market here. What do you make of the VIX, and what levels are you watching?
So right now, spot's around 13.5. So this denotes less than 1% moves in the broad markets each day, roughly. Looking at the longer term chart, typically when we trend down below that 16 area into the 13 area, it's possible to get down as low as 9, 10 and have a very dull, gradual rise to the upside in broad markets. So hedging overall becomes a bit easier because you don't want to have that drag effect by purchasing insurance too preemptively. Ways that you can do this perhaps are using put spreads. And then the wider you go, obviously, the more asymmetry of risk you have, but you're also risking a bit more capital. If you go with narrower put spreads, for example, like $10 wides on SPX to the downside, you can find asymmetry of risk where you're risking 2 to make 8 or 3 to make 7, for example, which isn't that great overall. But if you go a bit wider using, 50 wides, for example, you can find some trades where you're risking, $3 to $4 to make 46, for example, right? Again, these are tail risk trades where if the market were to sell off, 5% all of a sudden or 7% all of a sudden, that's where you're protected, right?
I couldn't agree with you more, Nick. The skew in the options chain truly allows you to build some asymmetric payoff put spreads on the downside. They don't cost a lot, and they give you that really good intrinsic value kick if the market gets hammered to the downside. What I find interesting is that when we go on page 10 and we look at the VIX for the 1-year volatility, because the normal VIX chart we look at is 30-day volatility, what's interesting is we are also as well at multi-year lows again. I mean, we're not back to 2019 levels, but even volatility 1 year out is at multi-year lows. And one of the strategies, Nick, that I cover, and I'm doing a webinar on that as well, is the ratio back spread. And the ratio back spread, I haven't talked about it for years because high volatile conditions actually make it harder to implement and have all sorts of inherent risks with it. But the lower volatility goes, tighter that back spreads can be put on and the less vega risk you have. It's a really interesting way to implement hedging. And I'm going to be doing a webinar on that actually in not this upcoming week, but next week on July 25th. The links are in the chart deck and as well in the Research Roundup email. So anyone that wants to learn about these different option strategies, you're welcome to join me for that. But it's interesting, Nick, that volatility, like the market is just becoming so complacent, like a soft landing or no landing is really the most probable outcome. I'm really curious to see, as we progress into deeper into the third quarter, whether or not the market ends up getting some sort of data point that actually makes everyone reprice risk again.
My thinking there is that, Powell has said again and again that the Fed has not even thinking about lowering rates this year. And, the markets are pricing in a few rate cuts by the end of the year. And that becomes less and less likely as we approach the end of the year, right? Because we have July, which is in a few weeks. They're probably going to raise rates by 25 basis points. August is a holiday, September, October, November, December. So the probability of cuts occurring this year are not very high. But remember that when the Fed pauses, typically that indicates the top in the market. So it's possible that it happens later on. Again, the catalyst is unknown as to the downside catalyst, perhaps. But it's important to be cautious because there is a lot of FOMO, as you said, in the markets right now. So moving on to page 11, we have the US dollar index. Eric, what are your thoughts here?
For weeks and weeks now, you've heard me saying, look, there's nothing to see here because we're stuck right in the middle of a wide consolidation range. But just in the last couple of days, this has gotten very interesting. The signal I've been waiting for is a daily close below 100 on the Dixie. And while we don't have it quite yet, we're down 3 big handles this week alone. And as of Wednesday's close, the Dixie is just barely holding above 100. If this dollar weakening move continues, it could accelerate on a sustained move below 100. And of course, that also means that the market could reverse much higher from here if critical round number support holds. So it's time to wake up and pay attention. But so far, the verdict is still out.
Yeah, Eric, the 100 level is really important, but I have to say, I was anticipating far more of a trade range bound currency market, and the sheer velocity of the US dollar breakdown has me having to go back to the drawing board to really ask what's going on here. It's going to be critical to see what happens here, because if we have a euro blowing out through above the 112 level on the upside, and we continue to see all the other cross currencies just breaking out right across the board, the question then becomes, is there another leg down in the dollar? And if there was, in my opinion, any one true tailwind for risk assets for the third quarter of the year, would be a material repricing of the dollar lower. And I mean, nothing crazy, but like if we saw the Dixie heading down to the 95 handle, just levels where we saw it a few years back, that would certainly, I think, be a tailwind, and that could actually be the backdrop from which many commodities can rally, and even risk assets like equities would find that as a tailwind for potentially driving those previous highs. So watching what happens here in the dollar next is so critical. I think that in order for this to the bulls to neutralize this, we would need to see a rejection of the euro at 112 and a dollar index that gets right back into that trade range above that 101, 102 range in the coming weeks. So that's certainly the thing to watch there.
Now on page 12, we have the gold futures chart. What are you guys thinking here?
This move higher looks to me like it has legs, so kudos to Patrick for seeing it coming last week. One of the factors that may have helped turn the market around was a series of announcements over the last couple of weeks about the formative gold-backed BRICS contender for replacing the US dollar as global reserve currency. Exactly as I predicted in my book, Beyond Blockchain, 5 years ago, the BRICS Alliance has now formally announced its intentions to assert a gold-backed reserve currency system intended for the express purpose of competing with the US dollar as an international reserve currency for international trade settlement. The Western institutional finance community is either completely ignoring this or laughing it off as insignificant, but I think that they are badly overconfident. I personally see this confirmation as a very significant development, and the recent announcements serve to solidify my own strong bullish conviction for the yellow metal in the long term. What this means is that if, just by some crazy, unlikely chance, the almighty U.S. dollar should ever start to lose its monopoly over the global financial system, and if this BRICS alternative reserve currency system were actually to get traction and take off and become a meaningful part of the global financial system, then, as that currency gained popularity, it would be necessary for its managers to buy up more gold at whatever price the market commands in order to create more money supply. It's not discretionary buying based on an opinion about what value is, and it doesn't depend on anybody's personal opinion as to what an ounce of shiny yellow metal is worth. It's just a mechanical thing where if this BRICS reserve currency does start to take off, it's a guaranteed certain fact that they have to buy more gold regardless of price anytime they want to increase the money supply. But according to the Western finance community, there's no chance of any of this really happening because the U.S. dollar will always reign supreme. According to the exact same people who all insisted that the yuan-priced crude oil futures contract would never see any serious open interest or volume until it did. So I think they've badly underestimated this, and I think it's another reason to be very, very bullish in the long term on gold. But I digress. Returning to the current market, I think we still have a couple of rate hike surprises in our future. So I don't think it will be a straight line up for gold, and lower prices below 1900 are still entirely possible. But for the moment, it looks like gold is catching a bid, and the correction may be ending sooner than I originally anticipated.
Well, thanks for the kudos, Eric, but I don't know if I saw it coming. All we were just talking about was that, we were approaching key fib zones. The 200-day moving average was right there, and the U.S. dollar weakness is typically a condition that would be a tailwind for gold. So we had this breakout, and the breakout happened yesterday, and certainly looks like it's holding this morning when the time we're recording. What really, to me, it's not the breakout candle itself that matters, but rather whether the bulls follow through on it in the coming trading sessions. And the one thing that I think would be very disappointing for the gold bulls would be if this traded back to 19 and a quarter by midweek next week. What really needs to happen here for there to be a bull tailwind is this constructively crawl its way higher to 2,000 and really start getting the attention from traders, investors that there's a new move underway. If that happens, a retest of its previous highs just below 2,100 and even a breakout towards 2,200 are all entirely on the table. The beautiful part about this is it's an early stage breakout, so there's a lot of upside here. Let's see whether the bulls can pull it off.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.